This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
So joining us here in the Postgame is Harley Bassman. Harley, welcome back to the show.
Thank you very much. Glad to be here.
Well, you know, it's only been a few weeks since you've been on the show, but, you know, there's been so much going on, and particularly you touched on some really neat option strategies in your recent pieces, and I thought we'd bring you back, and so we could pick your brain on different ways to implement different option strategies in this environment. So you just actually released a Convexity Maven piece titled "With a Mighty Hand and an Outstretched Arm." For those of our listeners that want to read the piece, we are going to link it in our Research Roundup email. Now, in here, you touch on a whole wave of different things, but I wanted to just right off the bat start off with the S&P 500, which was toward the bottom end of your piece. And you talk there about this idea of putting on this risk reversal trade on the S&P. So why don't you first talk us through just very quick summary of why your thesis is about the S&P potentially having some upside and why this is a really interesting way of implementing the trade.
You know, it does seem crazy to be bullish on any equity, financial asset right now with unemployment still very high and, you know, the virus still, you know, early stages of the pandemic. But the reality is the Fed is going to be printing money. They've run at a 65%, you know, expansion rate, and they're buying everything. And so I'm just going to not fight the Fed and say they're going to keep pumping money into the system. And therefore, I kind of want to get long. And how do you get long? You could buy stocks outright. What I said is to put a risk reversal where you buy an out-of-the-money call and sell an out-of-the-money put for basically a zero cost. When the market was at 3,300 on the SPY, you can go out 2.5 years, which is great. It's listed. It's very liquid. You could buy the 340 call, which is the old high. You can sell the 230 put, which I've gone through in my piece the math on that, for zero cost. I would not say this is a hedge fund leveraged spec trade. I would say it's an asset replacement trade. It's a better beta trade. So if you already own equity exposure, which I'm sure you do, this is a much better way to gain that exposure than owning stocks outright.
You know, I do really like it. I mean, it's a zero cost, and your starting delta is about 70 cents on the dollar of the combination of the two, and you got some gamma on the trade. But what immediately caught me on the trade was, and I wanted your opinion on this, because instinctually when I look at this trade and I'm thinking about the notional dollar exposure if I held to maturity, it doesn't match because in the end you're either going to, let's say the SPYs, you get in the money on the call at 340, you're going to call in $34,000 of S&P exposure, or at least you have the notional exposure on the upside. But if the put is being put to you at 230, you're only being assigned $23,000 of stock on the S&P. What do you think of the idea of matching the notional assignment where, let's say, for every 2 calls that you buy, you sell 3 puts? Do you like that idea, or what would I be missing on sizing the trade that way?
Well, I mean, you could do any kind of combination you want, and these trades work very well because of the skew and because the forward price is downward sloping because of the inversion of the dividend rate versus the borrow rate. I kind of think I'm going to be loving the idea of owning 3-2 on that trade. Really, I'm thinking about it's an asset replacement, it's a better beta. And if you own stocks when they get down to a lower level, you own less of them. That's the convexity of equities, is that when you think about it, the most you could lose is 100%, but you could make 2, 3, 4, 10 times. And this trade is very interesting in the sense that you have this stocks, equities, which are long convexity effectively, and you're buying a call option above it. So you're buying options on options. It's a very convex trade. And on the downside, if you own stocks right now at 3,100 and they drop 10, 20%, you lose 1-for-1. In this trade here, although the mark-to-market would go against you initially, at the end of the day, you're not long stocks until down at 230, which is why it's a better avenue. The way you lose on this trade, in theory, is we rally only 3 or 5, 10%, and you never cross the upside strike. And if you'd owned the assets, you would have made that small amount of money. That's a pretty small window to assume we're going to be there 2.5 years from now. We're going to be higher or lower. And the option market's already telling you that with the VIX near 30. We're not going to be here in 2.5 years.
Right. Now, earlier in the article, you touched on mortgage REITs. And first of all, I'd love to just hear you give a quick summary of your thesis on mortgage REITs. But when I was reading it, the first thing I thought of was back many months ago, you published the MLP trade, and you used a very similar style strategy of selling a put and buying a call on the upside. And I was thinking, well, would that work on Annaly or some other mortgage REIT in that scenario? And so if you could first just start off with your bigger thesis and then just comment on whether or not this is a good fit for that type of an option strategy.
Sure. Most REITs that you read about are property REITs, they're equity REITs, they're people buying assets and putting them into a structure. A mortgage REIT is very different. It's where you're basically buying bonds, mortgages on residential property. Mostly for the big ones, Annaly or AGNC, they're buying Fannie and Freddie bonds. There is no credit risk. And right now the Fed is supporting that market by buying them, once a month. They buy these mortgage, Fannie, Freddie, Ginnie assets. They hedge them out with swaps, swaptions, maybe 5-to-1, 8-to-1, 10-to-1. And they're creating right now a 10, 11% dividend. I find it incredible to have a 10% yielding asset with no credit risk versus a, 0.65 10-year. So I think it's a great cash flow investment that's relatively safe. If you had crazy volatility, I guess it could be a problem, but not too much. As to what you've suggested, you're spot on right. The options price off of the forward, not the spot price. And when you have call it 10, 11% dividend right now versus a 1% cost of funds, the forward price is going to be down about 10% per year as you go on out. And so you could create structures where you actually buy calls struck under today's current price and sell much further out of the money puts for zero cost. Now you're giving up the dividend because you're embedding that dividend into the option structure. But it's not a bad strategy at all. You got to be careful to make sure that the options are pricing correctly. But in general, you are spot on right with the concept.
Well, touching back on that AMLP, has your position or opinion about that space changed at all, or do you still think it's an opportunity? Do you still think that there's room to put on a trade even at these lower levels on that AMLP?
AMLP is very interesting right now. I will say it has not worked as expected. There's an oil component. There's a credit component. Our sector is cheap, but I would not be adding to it. I'm holding what I have right now. Some of the calls on AMLP are inexpensive. For that particular asset, I would do the calls only and not sell the puts. They will be very cheap versus the value of the asset because they have a very high coupon on that ETF. And it's very liquid also, which is very helpful.
Right. So what I wanted to leave the conversation, or the last topic to touch on, is taking into account today's volatility conditions. We've covered in past episodes this idea of going long volatility with things like back spreads. But when we were having a conversation, you were pointing out some of the volatility risks in these heightened volatile periods that could sting you in a period where volatility could normalize. And so I wanted you to just comment on today's volatility conditions in the options market in general. And what is the strategy that is in these types of market conditions ideal for the type of volatility we are seeing in the markets?
Back spreads or 2x1s, as I refer to them, great idea. But they're really well suited for when vol is low. The VIX is low. The VIX at 12, it's a home run to go and sell one option and buy twice as many because you're getting long optionality at a low implied vol. Right now, the VIX at 30.
And long Vega, right? And so you're getting that kicker of the volatility works in your favor, right?
Exactly. With the VIX at 30 and the long-term average at 21, I'm not loving owning two options at 30 versus only being short one of them. It requires an awful lot of management to make that trade work. It can be a winner, but it requires a lot more management. The trade I love right now is basically specifically selling on SPY, selling the 240 put for October, and buying a 225 put for December. Ordinarily, in an options on SPY, The term surface points up. So a longer dated option has a higher implied vol. Also, the skew points, down, up. And a more out of the money put has a higher vol. So a longer maturity, lower strike option should trade to a much higher implied volatility than a shorter option. I could sell the 240 in October, buy the 225 in December, basically flat vol right now, which is rather impressive. Trade costs about a point and change, 0.10, 0.15. And on top of this, the ordinary surface being, kind of interesting for me, I'm short October, I'm long December. This trade carries very well. We could stay up or down, up 10%, down 20% from now to September, October, and this trade will actually lose no value at all because of the decay pattern. And if things go really haywire, I own that downside put at a very cheap price. You do have the risk, in theory, of losing 15 points because you're short the 240 and long the 225. That's possible. I see it very unlikely that we're going to make new lows before the election.
I was about to say, you mentioned the election. I thought it was really interesting that it's almost like an election play because the one option will roll off before the results of the election and you have the other one long through the election. I mean, was that in your thought process when you were picking those two?
That's exactly my thought. I basically get to own the election risk. I won't say for free, but the trade is positive carry. We don't move. This package goes up in price. So you think about that. You get to own positive carry to own the election. This election, I guess it could be something. It could be simple, but I don't think so. It's already pretty rough, and it's going to get rougher, after the summer.
Harley, I cannot thank you enough for taking the time out of your day to join us right before the long weekend to talk options. But great insights. Thank you very much, and we look forward to having you back on the show in the future.
Thank you so much. Have a good day.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.